Ever heard someone say a company just split their stock? It might sound strange, like dividing a birthday cake into more slices without adding any more frosting. But in the world of investing, stock splits are a common move that can impact your portfolio. So grab your metaphorical magnifying glass and metaphorical chef's hat, because today we're going to explore the ABCs of stock splits. What they are, why companies do them, and most importantly, what it means for you as an investor. Imagine you own a limited edition vinyl record of your favorite band. It's rare, valuable, and brings you joy every time you listen to it. Suddenly, the record company announces they're pressing 10 identical copies of your record for every original one. Would the value of your record magically skyrocket? Of course not. Stock splits work similarly. The company doesn't magically create more value. They simply divide the existing ownership, shares, into a larger number. Think of a company's total value as a delicious chocolate pie. Before a split, the pie is divided into a certain number of slices, shares. After a split, the pie remains the same size, but there are now more thinner slices, shares, representing the same overall value. Let's talk about stock split ratio. This tells you how many new shares you'll receive for each existing share you own. A 3-for-1 split means you get 3 new shares for every 1 share you previously held. A 2-for-1 split would give you 2 new shares for every 1 existing share, and so on. Why do companies do stock splits? The first reason is increase affordability. A lower share price can make the stock more attractive to a wider range of investors, potentially increasing trading volume and liquidity. Think of it like cutting your chocolate pie into smaller slices. More people can afford a slice, leading to a livelier party, more active trading. Also, we should consider the psychological appeal. A lower share price might seem more psychologically appealing to some investors, even though the underlying value remains the same. Imagine a friend offering you a large, expensive slice of chocolate cake versus several smaller, more manageable pieces. You might be more likely to accept a smaller, more affordable slice. It is a way of signaling confidence. Sometimes a split can be seen as a sign of management's confidence in the company's future growth. Think of it like the record company believing their band is so good, they want to share their music with a wider audience by pressing more records. However, it's important to remember that a stock split is just one action, and the company's future performance still matters most. However, what does a stock split mean for you? The total value of your investment stays the same. It's like having the same amount of chocolate just divided into more pieces. You'll own more shares, each with a proportionally lower price. Imagine having 3 smaller slices of pie instead of 1 large one. Your voting rights remain proportional to your ownership percentage. Even though you have more slices, your influence within the company, voting power, stays the same. Stock splits don't guarantee future price increases. The company's performance still matters most. Just because you have more slices of pie doesn't mean the recipe is suddenly better. Please remember, don't chase stock splits solely based on the hope of a price surge. Remember, the pie is still the same size. Focus on the company's fundamentals, growth potential, and overall health before making investment decisions. Research the recipe, not just the number of slices. Use stock splits as an opportunity to reevaluate your investment strategy and adjust positions if needed. Maybe you want to use the split to diversify your portfolio by selling some shares and investing in other companies. Let's explore some real-world examples of famous stock splits. The first one on our list is Apple. In 2014, Apple implemented a 7-for-1 stock split. This split made Apple's shares more accessible to a wider range of investors, potentially contributing to increased trading activity and a rise in the company's overall market value in the long run. However, it's important to remember that the stock split itself didn't create more value, just more shares. Following, we have Tesla. In 2020, Tesla underwent a 5-for-1 stock split. Similar to Apple, this move aimed to make Tesla's shares more affordable and potentially attract a broader investor base. While the split itself didn't directly impact the company's value, it could have contributed to the significant increase in Tesla's stock price following the split, driven by other factors like investor confidence in the electric vehicle market. Also on our list is Amazon. The e-commerce giant has undergone multiple stock splits throughout its history. The most recent one, a 20-for-1 split, occurred in 2022. Amazon's stock splits have historically been followed by periods of growth, but it's crucial to remember that correlation doesn't equal causation. The company's strong fundamentals and strategic direction likely played a larger role in its long-term success. Feeling curious for more? Let's explore some real-world examples of famous stock splits in the comments below. Tell us which company you'd be most excited to see announce a stock split and why. Do you think it would be a positive sign for the company's future? Remember, knowledge is power. The more you understand about stock splits and other investment strategies, the better equipped you'll be to navigate the financial world with confidence. Did you find this breakdown of stock splits helpful? Leave a like and subscribe for more investment insights delivered in a clear and engaging way. We'll be diving deeper into various investment topics to empower you on your financial journey. And if you have any questions or specific investment strategies you'd like us to explore, leave a comment below. Thanks for joining us and happy investing.